Financial Accounting Part 2. So for this afternoon, we'll be discussing about the other side of the balance sheet. Now, if you would recall, during the Part 1, in the accounting equation, you have assets is equal to liabilities plus equity. So this we have taken up in our Part 1. So for this Part 2, we will be discussing about the other two components of the accounting equation, which are liabilities and equity. Now, we will start with liabilities. Okay, so this is the Part 1 of the lecture for liabilities. Now, first and foremost, let us go to the definition of a liability. Now, every time I discuss an item in the statement of financial position, I always start with the definition of an item. Okay, so liability, according to our standard, is a present obligation. So, number one, it is a present obligation. Okay, present obligation of an entity. Okay, and number two, portion of the definition is that it would require a transfer of resource. Okay, so there's going to be a transfer of resource from the entity to another entity. And the third one is that it is what? It is a result of a past event. So there is a liability because of a past event. Okay, so these are the three important points that we have to understand about the definition of a liability. Number one is that it is a present obligation of an entity to transfer economic resources. Economic resources like what? Like cash, for example. So if you purchase something which you haven't paid for, then there's an obligation for you to transfer cash to your supplier in order to settle the liability. And number three, the liability came about because there is a past event or transaction. Okay, so let's say, for example, you purchase an equipment from a supplier or vendor that you haven't paid for. So therefore, there is a liability on your part because it is an obligation. There's an obligation for the entity to transfer resource. And what kind of resource is that? That is cash. Okay, and of course, this was because of a purchase transaction that occurred sometime in the past. Okay, so that's the basic definition of a liability. Now, next one is the measurement. Okay, now for the initial measurement of obligation, so the question is, at what amount are we going to value or measure the obligation for the first time? Okay, so when the company records the obligation in the books of accounts, at what amount are we going to measure or record the obligation? So conceptually, we record liabilities at the present value or at its present value. Okay, however, so when you speak of present value, that is the value as of the recording date. Okay, however, for current liabilities, we normally do not do present value anymore. Why? Because we presume that the effect of doing the present value is already immaterial to the financial statements taken as a whole. Okay, so for current liabilities, the initial measurement will be the present value of the obligation, which is essentially equivalent to the face amount of the obligation. Now, for non-current liabilities, when we speak of non-current liabilities, these are obligations that would be paid, okay, outside the 12-month period, because anything that will be paid within the next 12 months from the FS date is what we call current liabilities. Okay, but for those obligations that will not be paid within the 12-month period, then those are what we refer to as non-current liabilities. Okay, so for non-current liabilities for initial measurement, okay, so again, we do present value. So we find for the present value of the obligation, okay, and then, so this is the first one. But you have to understand, or you have to know first, remember that for non-current liabilities, there are two types. It could either be non-interest bearing, or number two, interest-bearing obligation. Okay? So when you speak of non-interest bearing, there's no explicit interest rate that's indicated in the promissory note, but it is already implicit or included in the principal amount of the obligation. When you speak of interest-bearing obligations or liabilities, these are liabilities that are what? That bears interest. Okay? Now, for the interest-bearing liabilities, okay, we have to understand that there are two types of interest. You have the nominal interest and you have the effective interest. Okay, the nominal interest is the amount of interest that is included or that is indicated in the promissory note. And the effective interest, that is the market rate of interest. Okay? Now, there are times that the nominal is equal to the effective, and there are times that they are not the same. The nominal could be higher than the effective, or the effective could be higher than the nominal. Okay? Now, what are we going to do with this one? So, for the non-interest bearing note, we find the present value of the obligation. Now, for this interest bearing note, again, we find for the present value of the obligation. Now, depending on if the nominal interest is equal to the effective interest rate of the obligation. Okay? Now, there's a difference between the principal, no, and the present value of the obligation. Okay? Now, the difference between this one is what we call the discount, and this discount is what? We amortize this over the period of the obligation as interest expense. Okay? Now, what is the difference between interest-bearing and non-interest bearing? As you can see on the slide, okay, if you would look at the time frame, okay, so today and the future. On the first scenario, today is what we call, in the first scenario, okay, today you have the value of the principal. Now, in the future value of the obligation is the principal plus, of course, the interest. Okay? Now, whereas on the second scenario, you have today and the future, the principal is the future value of the obligation. Now, if I ask you now, which of these two scenarios represents the interest-bearing liability and which is a non-interest-bearing liability? Can you spot the difference on the two scenarios? I'll give you 2 seconds to think about it. Okay, so what is your answer, guys? Scenario number 1 is what? Okay, if your answer is that scenario number 1 is the interest-bearing note, your answer is correct. If your answer is, in number 2 is, it is the non-interest-bearing obligation, then your answer is correct. Okay? So you could now spot the difference between the interest-bearing and the non-interest-bearing. And that is why we have to find the present value, okay, of the obligation. Now, for the interest-bearing note, there seems to be no problem because the future value of the obligation is the principal plus the interest. But for the non-interest-bearing obligation, okay, the principal is a future value. Right? The principal is a future value. Why is the principal a future value? Because there is, the principal already includes the interest. So what are we going to do? We have to find the present value of the obligation by discounting the principal amount to its present value. The value of that amount, okay, that is due sometime in the future, how much is it today? Okay, that is where we will use the present value. Okay? Now, let's go to current liabilities. So current liabilities, as I said earlier, these are obligations that will be paid by the entity within the next 12 months from the balance sheet date. So if we try to draw a timeline, okay, so if you try to draw a timeline, so if this is your timeline, okay, so if this is the FS preparation date, say December 31, 2018, okay? And what is 12 months from December 31, 2018? So 12 months from that is another FS will be done, that's December 31, 2019. So all obligations that will be paid within this 12-month period is called current liabilities. So if you prepare the financial statements as of December 31, 2018, all obligations that the company expects to pay within from January 1, 2019 until December 31, 2019 are considered current liabilities. Okay? Why? Whereas obligations that will be paid, say for example, within 2020 and 2021 are called non-current liabilities. So essentially, that's the difference between the current liabilities and the non-current liabilities. And what are the examples of current liabilities? So you have accounts payable with suppliers or trade suppliers, accrued expenses like interest, like salaries, okay, or rent, for example, utilities, okay, and of course the income tax payable, which is of course due to our government through the Bureau of Internal Revenue, okay. Now, next, non-current liabilities, which I already explained. These are liabilities that is expected to be settled after the 12-month period or beyond 12 months from the financial statement date. So, for example, we're talking of December 31, 2018 financial report. If the liability is due within 2019, so those are current. If the liabilities is due within 2020, and we're talking of 2018, then that's already a non-current liability. Okay? But if you prepare the financial statements December 31, 2019, all obligations that will be paid during 2020 until 12 months from December 31, 2019, which is December 31, 2020, are all considered current liabilities. And this one will be the non-current. Okay? So that's essentially the major difference between the two and how we determine. Okay? So let's have this example. On January 1, 2019, ZA Corporation obtained a 5-year loan from Bank of Commerce in the amount of 5 million with interest of 6.5. The loan will be paid every December 31 for the next 5 years, plus of course the interest. On December 31, 2019, is the loan current or non-current? Why or why not? Now, I'll give you like 10 seconds to go through the problem again and try to understand the problem and find the answer. Okay, so let us try to draw a timeline in order for us to be able to analyze the problem carefully. Okay? So sabi niya, so this is January 1, that's 2019. Okay? So here we obtain a loan from a local bank that's called Bank of Commerce. Okay? It's a 5-year loan. It's a 5-year loan in the amount of 5 million pesos. So here, there's a 5 million loan. So the question is, how will this be paid? According to the problem, it will be paid every December 31 for the next 5 years plus the interest. Okay, so every December 31, so this is December 31, 2019, December 31, 2020, December 31, 2021. Okay, so every December 31, we will have to pay 1 million to the bank. 1 million plus the interest. Okay? So 1 million plus the interest. Now you have seen this illustration earlier. So the question is, as of December 31, 2019, is the loan current or non-current? So the answer there is that the loan is what? A mixture of current and non-current liabilities. Why is that? Remember what I mentioned earlier, that all obligations that will be paid within 12 months from balance sheet date are considered current liabilities. So therefore, if you look at this one, okay, so if you're going to prepare the financial statements as of this one, as of December 31, 2019, okay, so how much will be current and how much will be non-current? Now, this amount is already settled by December 31, 2019. So how much is the outstanding portion? That's going to be 1 million plus the 1 million every year for the next 4 years. So in terms of principal, okay, there's 4 million that is still outstanding. Okay. Now, in terms of principal, okay. Now, how will this be paid? That's good. That this will be paid 1 million every year. So, what is 12 months from December 31, 2019? 12 months from this one is December 31, 2020. Now, if December 31, 2020 is 12 months from balance sheet date, so all payments that will be made until December 31, 2020 is what? That's correct. We consider them as current. So, in this case, how much of the obligation will be paid, or how much of the loan will be paid within 12 months from balance sheet date? Can you make a guess? Okay, that's correct. Therefore, out of the 4 million pesos, okay, out of this 4 million pesos loan okay, that is still due, 1 million will be paid within the next 12 months. That is until December 31, 2020. So therefore, the other 3 million is what? Will be paid after December 31, 2020. So therefore, the 1 million is considered what? That is considered current. And this 3 million is what? Considered non-current liability. So when you present this in your statement of financial position under liabilities, you present the 1 million as what? As current liability, and the 3 million pesos as non-current liability. Okay, do you understand? Okay, let's proceed. Okay, liabilities may be an actual liability or one that is contingent. Now, what's the difference between the two? When you say actual liabilities, the identity of the person or the entity may or may not be known to you. Okay? But it's an actual obligation of an entity. Okay? Now, the amount of liability may or also may not be exact or known to you in its entirety. Okay? So how do we know it's a actual liability? Because there is a contract, for example, that gives rise to the obligation. Okay? Whereas a contingent liability, it may or may not become an actual liability in the future. Okay? So pwede siyang maging liability, pwedeng hindi. It all depends on the happening of the event where the liability is anchored. Okay? So when you speak of actual liability, as we said, identity of the person may or may not be known. So if the identity of the person is known, then the obligation, the amount of obligation is also known. Okay? So, like, what are the examples of these types of liabilities? So you have your accounts payable to trade suppliers, you have your accrued expenses, say for example, to employees in the form of salaries, to banks in the form of interest, okay, and all others, okay? And then if you have, say for example, advances coming from related parties or officers, then those are actual liabilities. Now, what are the liabilities that the amount is not, the exact amount is not known, nor the party to whom you have an obligation is not known as of the moment. But you know that you have an obligation. Okay? Those are the types of liabilities that we call estimated liabilities. Okay? So, for estimated liabilities, the actual entities or persons, or could be institutions, okay, from which we have a liability may or may not be known to us as of the balance sheet date. But we know that we have an obligation. So what do? We make an estimate of how much the liability would be, okay, for this type of obligation. So for that, management will be making use of estimates and judgments in coming up with the amount of liability that we have to recognize in the books. Okay? For contingent liabilities, as I mentioned, they may or may not become an actual liability in the future. So again, exercise of judgment and estimates may have to be made by management. Okay, so if, say for example, a contingent event happen in the future, then there is an actual liability. But if it will not happen, then there is no liability. Like in the case of lawsuits, for example, you were sued by your, say, say you sued your employer for illegal termination. Now, on the employer side, it may or may not become an actual liability. So if it will be decided upon by the NLRC that the company is guilty, then it will become an actual liability. Otherwise, there's no liability for them. Okay? So that is a contingent liability. So these are examples of actual liabilities with known amounts. Okay? You have trade accounts payable. Why? Because that represents the purchase you made to a supplier. Okay? So in which case, you know how much you owe to the supplier. Okay? For goods that you have ordered or that were delivered to you. Okay? Accrued expenses, like say for example, interest expense. Why? Because you know how much the loan is, the principal of the loan, and you know the terms and conditions of the loan. Salaries, because you know the amount of salaries that is not yet paid to employees. Okay? The rent, the utilities, all of these information are known to you. So these are liabilities with known amounts. Okay? The contributions that will have to be remitted to SSS, Pag-ibig, and PhilHealth as contributions of the employer and the employee and of course the value added tax or the VAT payable. Now let's go through one by one. Okay, so trade accounts payable. So when you order something from your vendor or supplier and you haven't paid for the order, then there is a trade accounts payable. That is your obligation to transfer resource to your supplier as a result of a purchase transaction that happened in the past. Okay? Now, trade accounts payable may be recorded, as you know, in your inventories at gross or at net amount. Let's show the differences, the difference between the two. So in recording our trade payables, so we have the gross and the net. So you have there listed on the slide, you have the transactions and then the entries, how much will be recognized under the gross and the net. Okay, so for example, January 1, bought merchandise for 100,000 subject to the following. So 2 over 10 and over 30. So there's a discount. When you say discount, so the amount that will be settled may or may not be lower, okay, than the original amount. Now, if the company pays within 10 days from the purchase date, then they are entitled to a 2% discount. Otherwise, if they settled outside the 10-day period, then they will have to pay the whole amount of the obligation. Okay? So under the gross and the net, under the gross, so your recording will be merchandise inventory or purchases if you're using the periodic for 100,000 and accounts payable for 100,000. Now under the net method, as the term implies net, it means that at the initial recognition, you don't recognize the discount anymore. So you record the merchandise and the accounts payable or the liability net of the related discount. So how much will be recorded? So that will be debit your merchandise inventory and or purchases, depending on the inventory method that you're using, for 98,000 and credit your accounts payable for 98,000. Okay? Now upon settlement, we will make two assumptions. Number one, that the company was able to settle it during the discount period. So if you settle it during the discount period, you are entitled to the 2% discount. Okay, when should the company settle the obligation? So it says there, January 1 and 2 over 10. So 10 plus 1, that's going to be January 11. So if the company pays the obligation until January 11, then they are entitled to a 2% discount. Okay? So what will be the entry for the gross? Remember, at the gross method, we do not recognize the discount first, no? So at initial recognition, we value the merchandise inventory or the purchases and the obligation at gross. So at this time, upon settlement, okay, so assumption 1 is that they settled in full within discount period, we will have to deduct the 2% discount from the amount of the obligation, okay? So therefore, our accounts payable will be debited for 100,000 and then cash will be credited for the net of the discount. That is 2% of 100,000 or 98,000 and then credit your purchase discount or merchandise inventory if you're using the period, merchandise inventory if you're using the perpetual, and purchases if you're using the purchase discount if you're using the periodic. Now under the net method, now remember that upon initial recognition, what we did is we recognized the obligation, okay, net and the inventory, net of the discount. So there's no issue anymore because we are entitled to the discount since we paid the whole amount during the discount period. So all we need to do is to debit our accounts payable for 98,000 and credit cash for 98,000. Now, for the second assumption, the assumption is that the obligation was not settled in full during the discount period. So what are we going to do with that? Okay, so if that is the case, then we will have to pay the whole obligation. So under the gross method, okay, we will debit accounts payable for 100,000 and credit cash for 100,000. Now, under the net method, on the other hand, remember that we recognize the accounts payable at net amount. But the problem here is that we are going to pay it at full amount, which is 100,000, because we are not entitled to the discount. So therefore, what will be our entry? So entry will be debit our accounts payable for 98,000 and credit cash for 100,000. So there's 2,000 pesos this balance between the debit and credit. And what are we going to charge for that? We will charge it to purchase discount loss. Okay? So purchase discount loss. It's a debit. So where do we show it? We will show it as part of other income or other expense. It's a management item to tell management that, we were not able to avail of the discount. And as you know, prudent management would avail of any discounts available in order to lower down the operating cost of the company. Okay? So that's the difference between recording of trade payables at gross and recording it at net. Next, accrued expenses. So these are expenses that you have already received the benefit. Okay? You've already used, say for example, if it's a loan, you've already used the cash. If it's utilities, you already used the utilities, you were able to sleep in the comfort of your room because of air conditioning unit. Okay, but you haven't paid for it because the billing comes out the following month. Okay, so what you do is you make an estimate of the amount of obligation to, say, Meralco or employees or whatsoever. Now, let's take this example. On November 1, 2020, ZA Corporation obtained a 10 million term loan from Bank of Commerce. The loan is due on December 31, 2025. So, it means that the loan is what? The loan is long term. Okay? Okay. Interest is payable annually every October 31. I guess the missing link here, sorry I was not able to indicate. The interest is 6%. Okay? So how much is the accrued interest as of December 31, 2021? Okay. Now remember that the loan originated 2020. Okay, but what is being asked is, how much is the interest as of December 31? Remember, it was said that interest is payable annually every October 31. So October 31, 2021, you've already paid the interest from last year up to the current year. So what remains is what? November, December. So 2 months is unpaid for this interest, and that will be paid the following year. So therefore, the accrued interest is how much? That would be, how much is that? October 31, sorry, magkano? 10 million. So 10 million times 6% times 2 over 12. Okay? So that will be our accrued interest. And how much will that be? Let me calculate. Okay, so that will be 100,000. Sorry. Okay, so 100,000 is the accrued interest on the loan. Okay? As of December 31, 2021. Okay? So you get the same amount, 100,000. Okay, that's good. Next. Okay, so now let's go to another current liability, which are the payroll-related deductions or contributions. Now, when you join the workforce, sometime in 2 to 3 years probably, okay. So you'll be engaged, or you will be employed by a company, and when you're employed, you are expected to receive your salary. So say for example, the negotiated amount of salary is like 20,000 pesos. So at the end of each month, you will receive your compensation. Now, depending on the practice, it could be bi-monthly or it could be monthly, okay. But nonetheless, you don't expect to receive 20,000 pesos or the gross amount. Why is that? Because there are certain mandatory contributions that will be shared between you and the employer. Okay? And these are the contributions for this: Social Security, Pag-ibig, PhilHealth, and withholding tax and compensation. So all of this will be deducted from your gross pay to determine how much your net pay, okay, for the period. Okay? Now, what are the functions or the importance of these contributions? Now, say for example, Social Security System contributions. Okay? The SSS contributions will give you pension during the year, or until you die. And if you have a wife or a family, then they will be benefited. Okay, as the SSS will pay you pension benefits. So when you retire, then you will start receiving pension benefits from Social Security system. Okay, so that will be deducted from your salary and will be given to you after your retirement. Okay, now pag-ibig contributions on the other hand, so these are for housing loans, okay, for salary loans, okay, but maybe these are really for housing loans. So say for example, in the future, you want to avail of a housing loan. If you're a pag-ibig member and all employees are now are mandated to become pag-ibig members, then you can avail of housing loan from pag-ibig. Okay, that will aid you in terms of acquiring your home, yung mga may gusto magkaroon ng bahay dyan. Okay? Now, PhilHealth contributions on the other hand, now you know that there's already an issue on PhilHealth nowadays, no? According to them, there's a mafia in the system, okay, and the funds are being siphoned out, okay? These are actually funds of the members of PhilHealth. Now, what it does, if you say, for example, get sick, then portion of your hospital bills will be shouldered by PhilHealth, and that will be taken from the fund contributed by all the members of PhilHealth. Now, with the Universal Health Law, everyone becomes a member of the PhilHealth. So even if your mom, for example, is a senior citizen, she is a member of PhilHealth, and so therefore she will receive that benefit in the future. Okay. Now, withholding tax and compensation, again, these are our contributions to the government. Okay. So for employees, even before you receive your pay or your salary, a portion of that has already been deducted from the gross amount, okay, and remitted to the government by your employer on your behalf. Okay, so we'll discuss each one. Now, for SSS contributions, we have a schedule or a table to determine how much is the contribution of the employee and the employer. Yes, you heard it right. If you are a member of SSS or Social Security System, you will contribute and your employer will also contribute for you. Okay, so upon retirement, again, you will receive pension from SSS. Okay, and that is contributed by you and by your employer. Okay, if you look at the table, okay, so there's a salary range. So it depends on the amount of salary of the employee. Okay, so the contribution of the employee and the employer would be dependent on the salary level of the staff. Okay, so those are actually monthly contributions. So you have the ER for the employer and the EE for the employee. If you would look at the contributions, the employers will contribute more than the employees, right? Okay, so if you look at the contribution table, no? Employees will be sharing a lot less amount in terms of contribution as compared to the employer. Okay, so the employee contribution will be deducted from the employee payroll. Okay, PhilHealth. So again, this will help you in paying your hospital bill should you become ill. Okay, so again, there is a bracket or a range, and the corresponding amount that will be shouldered by the employee and by the employer. Okay, so it's a combined contribution. Okay. Yan. So yan yung mga yun, no? And then, for pag-ibig, so this is a table for pag-ibig. Okay, so for 1,500 and below, the employee will share 1% of the amount, and then 2% will be from the employer. Now, over 1,500, that's 2 and 2%. So, at this time and age, I don't think there's still, employees receiving less than 1,500. So, everyone will be under the 4% contribution. Now, the last deduction will be the withholding tax on compensation. Okay? So, this is, again, our contribution to the government so that the government can fulfill their mandate of what? Infrastructure, giving services to the people. Okay? And, of course, paying the salaries of government employees. This is our contribution for national development. So, I am encouraging everyone, okay, when you graduate, when you enter the labor force, you have to contribute to the government. If you have a business, You have to be ethical in terms of running your business. Always pay the correct amount of tax. Okay? So in computing the withholding tax on the compensation of employees, we have to take note of the following. Number one, we have those workers called minimum wage earners. So when we speak of minimum wage earners, they earn the minimum wage rate as prescribed by I forgot the organization, but it's prescribed by the government. And there are those that, with the implementation of the trade law, those earning 250,000 and below for 1 year are also exempted from paying withholding taxes on salaries. Okay, so these two are not subject to tax. Okay, so no tax shall be withheld on minimum wage earners and, of course, the 250,000 and below earners. Now, when you speak of minimum wage earners, the amount of minimum wage would depend on the location of the employee, of the employment or the employer. Okay, so if we're talking of employers situated or companies situated in Metro Manila or NCR, I guess the minimum daily wage is 537. So if you're giving your employees 537 pesos per day, they are called minimum wage earners. Okay, so the gross compensation, the 30th month pay, the overtime pay, they are not taxed if they are considered as minimum wage earners. Okay, if you go to provinces like Pampanga, Cebu, they have their own minimum wage rate. Okay, now of course PIR would take a look at the daily rate. Okay, not the monthly amount of compensation, because it could happen that an employee will be receiving, quite a huge sum because he's been working for 7 days a week, right? So it depends on the schedule of the employees. Okay, so let's have an example. So Zeus, a bagger at a local supermarket, earns 700 pesos per day as salary and works 6 days a week. Compute the tax and the net pay of Zeus for 1 month. So if you look at this one, so here's the computation of the salary and the net pay of Zeus. Sorry, before we go there, this is the withholding tax table for compensation when the trade law was effected or implemented. So we have the daily wage, the weekly, the bi-monthly, and then the monthly. Okay, so how do you look at this table? If you look at the compensation range, so if the taxable compensation for column 1 is 20,833 and below, that is not subject to any withholding tax. That's actually what's reflected there. So zero ang kanyang withholding tax. Under the column 2, so that is 20,833 net taxable income up to 33,322. The employee is subject to 20% of the amount above 20,833. So that's how you use the table. Okay? So let's go to the compensation of Zeus. Okay? So daily wage is 700 times 24 months. So the gross compensation is 16,800. Okay? Now, from the gross compensation, we deduct the contribution of the employee to SSS, PhilHealth, Pag-ibig, until you arrive at the taxable income. And if you see the taxable income, that's 15,688. Let's look at the table again. So that is under column 1. Okay, compensation range is 20,833 and below because it is how much? 15,688. So that is below, that is under column 1. So therefore, there is no withholding tax for the compensation. So therefore, the net pay is 15,688 pesos for the month. Okay? So how are we going to record this payroll and the related deductions? Okay? So first we record the payroll and the contribution of the employee as follows. So you have debit salaries and wages for the gross amount, that's 16,800. And then credit your SSS contributions payable for 580,000. Credit your PhilHealth contributions payable for 432,000. Credit your Pag-ibig contributions payable for 100 pesos. And then accrued salaries or cash for the net amount of 15,688. Okay? And then the employer will also have to recognize his share on the contribution. Okay? So the employer shall be recognized as debit to the employee benefits, credit to the to SSS contributions payable, PhilHealth, and Pag-ibig. So that's how we record. So at the end of the month, if you combine the two payables, what you will have, you have SSS contributions payable for 1,740,000 pesos. PhilHealth, how much is that? 864. And then Pag-ibig contributions is 200 pesos. So what are we going to do with those amounts? Remember, that's already the combination of the employee and the employer share. Now, these amounts will be remitted to the different government agencies like SSS, PhilHealth, and Pag-ibig. When are these going to be remitted? Following month. So therefore, at the end of the month, they will remain as liability of the employer and will be shown as current liabilities because they are expected to be paid within the next 12 months from the FSA. If the employer will not pay these contributions, they will be in bad shape with the government. Okay, employees might or will eventually complain that, they have been deducted this amount, but this amount will not remitted to the government on their behalf. So they cannot avail of the benefits, right, from these government agencies. So this will have to be remitted. And what will be the entry? So entry will be debit contributions payable, PhilHealth contributions payable, and Pag-ibig contributions payable in cash. So that will close the obligation the following month. Okay? So that's it. Next, of course, is the value-added tax. Okay? So what is value-added tax? So whenever you buy something outside, say for example, you go to your favorite fast food chain like Jollibee, McDonald's, no? Or your father would buy gasoline for the car. Those items have value-added tax, no? But not all items that you purchase have value-added tax. So you have to check on the document. Okay, what document am I referring to? The receipts, the invoices, okay, that you receive from your supplier to determine whether the item has VAT or has no VAT. Okay, and so input VAT, these are value-added taxes that you get from your purchases. So as I mentioned earlier, when you purchase from Jollibee, then you get your receipt. You will be able to determine how much is the input VAT. Okay. Output VAT, on the other hand, this actually arises from the sale of goods and service by the entity. Okay. Now remember that the timing and recognition of the output VAT or the value-added tax would depend if this is a sale of service or a sale of goods. So if it's a sale of service, then the company will have to recognize the output VAT upon collection from customer. So even if you say, for example, you make an accrual, debit accounts receivable and credit, say, service income, for financial reporting, service income may be taxable, but for VAT, that is not taxable because what will be subject to VAT is when you collect the receivable. So when there's already an entry debiting cash and crediting accounts receivable, that is when you have an obligation for value-added tax. Okay? So next one, sale of goods. So the recognition of VAT for sale of goods is upon delivery or upon sale. So when you receive the goods, then you have to recognize the input tax. When you sell the goods, whether it's paid or not yet paid by your buyer, then you also have to recognize your output VAT on the sale. Okay, let's have an example. So this is an example of an official receipt coming from a fast food chain for which I purchased my lunch today. So, how would you know if this is a VAT registered entity? Paano nga ba? If you look at the receipts, okay, at the upper portion of the receipt, there is what we call a VAT registered tin. Okay, so VAT registered, that means that the company is a VAT registered entity. And then it's showing the tin. So, how would you know if it's a non-VAT? What you will see on the upper portion will be NV. So it could be tin and then NV sa dulo. Okay. So when you see NV, that means that the transaction has no VAT. So you cannot recognize any VAT on that. Okay. So this sample receipt. Okay, on the part of Jollibee, this is a sale transaction. On my part, it's a purchase transaction. Okay? So therefore, for Jollibee, they will have to recognize output VAT from this purchase, or from this sale transaction. On my part, I will recognize an input VAT. Okay? So therefore, how do we record the VAT? On the part of Jollibee, Jollibee will recognize cash for 92 pesos, that is the actual amount paid, and then they will credit sales for the net of that. So we will remove the value-added tax, no? So value-added tax for 82.14, and then credit your output VAT payable for 9.86. So that's how we will record the VAT on the part of the seller of goods or service, okay? Now, the question is, so the output VAT is a liability, and that will be shown as part of the current liabilities of the company. Now, the question is that amount that they will have to remit to the BIR? Yes and no. Yes, if there is no input VAT. Okay? No, if there is an input VAT, because input VAT will be deducted from the output VAT to determine the liability of the company insofar as VAT is concerned. Okay? So the question is, where do they get their input VAT from? They could get it from the, purchase of supplies, payment of utilities, of rent, whatever payments or whatever purchase they made, they can get input VAT from there. So what they will do is record the input VAT based on the purchases and record the output VAT based on the sales. Now at the end of the month, okay, what they will do is make a listing of all of this and summarize, and then determine how much is the output as against the input VAT. Okay, so assuming the output VAT is 10,000 and the input VAT is 5,000, 10,000 is shown as part of current liabilities and the 5,000 is shown as part of current assets as input VAT. Now what will they do is they will now offset these two, okay, and then remit the difference. If the output VAT is higher, then there is an obligation to remit the difference to the BIR every 20th of the following month. So now, for example, month of August, this will be all transactions pertaining to VAT, like input and output, will have to be remitted to the BIR the following year. That is September 20th, okay, on or before September 20th, okay? So therefore, let us assume that the only VATable transaction is a purchase of supplies for 500,000. That's VAT inclusive. So therefore, let's compute first how much is the input VAT for the 500 pesos worth of supplies that were purchased. So how do we compute for that? So 500, since this is already VAT inclusive, so divide by 1.12 to get 100%. That is 446,000. And the input VAT is 12% of that, which is 53.57. So are we going to record that? So debit supplies, 446.43. Debit input VAT for 53.57. And credit cash for 500 pesos. Now the company has an input VAT. Input VAT is 53 as against output VAT. So how much do we have? So at the end of the month, the balances would be output VAT 9.86 and input VAT 53.57. Clearly in this example, input VAT is higher than the output VAT. So at the end of the month, what the company will do is to offset and prepare the VAT return. So the VAT return will show an output VAT of 9.86 and an input VAT of 53.57. So what are we going to do then? Company will then prepare this journal entry. What are we going to do? So this is now, we now have in this situation a net input VAT. Okay? So when we do an offsetting, there's a net input VAT of about 44 pesos. And that will be shown as part of current assets. Then output VAT would be 0. Okay? Now, what if the sale is 1,120? So what will be our entry? Our entry would be debit cash for 1,120, debit the sales for 1,000, and credit output VAT for 120 pesos. So again, you have an output VAT of 120,000. Okay? Sorry, 120 pesos. So at the end of the month, if we will assume the same supplies is the only purchase transaction that happened during the month, so output VAT will be 120 and then input VAT will be 53.57. So we can offset now the input VAT and we have a larger output VAT. So what will be our entry? Debit output VAT 53.57 and credit your input VAT for 53.57. So what will happen after this entry? We now have the T-account analysis for the output VAT. So it's showing that there is what? A 66 pesos, 0.43 pesos, 66.43 pesos net output VAT for this company. So what they will do is they will have to remit this 20th of the following month. Okay, so as of month end, this may be shown as part of liabilities, part of current liabilities of the company. Okay, as output value added tax. Okay, now what I'd like you to do now is get your pen and paper, and I will ask you to answer 5 exercises, and we will discuss the answers later. Okay, so give you 3 seconds to do that. When I get my chair. Okay, so are you ready, guys? Okay, let's have the problems. Let's start with exercise number 1. Okay, are you done? Let's have number 2. Number 2 is a theory question, and I adapted this from one local author, the famous one. Okay, are you done? Let's have the next one. Sorry. Okay, next one. Okay, and the last. Okay. So we'll discuss the answers to those 5 exercises during the synchronous session that we will have in the coming meetings. Okay. So thank you very much for sticking out with me on this short lecture about a portion of the current liabilities. If you haven't subscribed to my YouTube channel, please do subscribe, and of course you may click the bell button for you to be notified whenever I upload a new video. Okay, so it's Easy Learning with Prof. Zeus, Easy Learning in Accounting. Thank you very much, and hope to see you in the future uploads.